This video is brought to you by Preciseby.com, a simplified accounting software and an online invoicing platform. Click on the link below to find out more about Preciseby.com. The scandal that changed Andersen to Accenture. Steal a few, get jail. Steal millions, get a name change. Introduction.
The Arthur Andersen firm reached new horizons as one of the top industry leaders at the turn of the century. A revered Arthur Andersen firm dominated America's top 5 accounting and auditing firms. It comprised a fast-growing legion of over 350 offices in more than 70 countries. The industry titan was amassing over $8.1 billion in total revenues. Executives of this highest echelon, multi-billion-dollar giant, were living the American dream. A ticking time bomb of a Goliath scandal exploded. The Enron Scandal would go down the annals of history as the wickedest accounting and corporate fraud. Arthur Andersen firm disappeared in that tragic debacle. Keep listening for more jaw-dropping insights.
Who was Arthur Andersen?
Towards the turn of the century, Arthur Andersen was a household name in the accounting and auditing circles. You probably have guessed that Arthur Andersen named his organization as the Arthur Andersen Firm. But who was he? Arthur Edward Andersen was born in 1895. In 1908, Andersen received his bachelor's degree in business from Northwestern University. That same year, he proceeded to become America's youngest certified public accountant, at just 23. He was a pure genius, with a good nose for business. In 1913, he teamed up with Clarence Delaney and co-founded a firm called Andersen, Delaney and Company. However, his corporate marriage with Mr. Delaney soon escalated into a divorce and they parted ways, in 1918.
Arthur Andersen and Company begins to take off.
Mr. Andersen renamed his firm as Arthur Andersen and Company. It was a make-or-break moment for him. At the dawn of the 1920s, he started building up his empire by opening 6 new offices, with the firm's main offices in New York, Los Angeles, and Kansas City. The firm was growing rapidly. Its clients consisted mainly of many large industrial corporations and a range of utility companies. Its popularity was so widespread that Andersen's auditors and accountants assumed some cameo roles in the Samuel Insull case as expert witnesses. The firm's Andersen brand garnered a lot of respect in the academic, financial, accounting, and industrial circles, mostly for their impeccable skills and ethical code of conduct. What kept Mr. Andersen on his toes was his dedication to provide great service, high-quality audits, his drive to produce profits, and manage his workforce well. That, coupled with his keen sense of hiring the creme de la creme accountants, helped him to scout out and hire Leonard Spacek in 1928. That same year, the firm's employees grew to over 400 employees. What will likely amaze you is the fact that Andersen politely declined an opportunity to be the president of the concrete jungle economy, the New York Stock Exchange.
Andersen goes global.
The 1940s presented monumental changes for this fast-growing firm. Peripheral offices mushroomed rapidly in Boston, Atlanta, Houston, and Minneapolis. The swelling number of employees at Andersen and Company rose to 700 in 1940. Sadly, Mr. Andersen died in 1947 and Mr. Spacek took the reins as the firm's leader. During his tenure, the firm opened 18 new offices in the U.S. alone. It also grew immensely on the world stage when it expanded to the international market. The firm started off with 25 international offices across the globe. In 1950, something that would soon grip the whole world occurred. Joseph Glickoff's innovative ideas showed that the firm could use computers to automate bookkeeping and accounting systems. He was Andersen's engineer. So, in 1954, large business organizations queued up to Andersen's computer consulting business. Every big company sought to install and try out new automated accounting systems. Andersen saw an unparalleled economic upswing. In the 1960s, the firm went on to launch cost accounting, production control, and operations research. Their profits shot through the roof. Business was booming. The wave carried on to the 1970s. From there, the firm began to offer systems integration, strategic services, enhancement of software application products, and other technology-related services.
The $88 million court settlement.
The firm's brand did spread like wildfire all over the world. Amid that, there were potentially crippling disagreements and ugly problems engulfing the company. The Andersen Consulting Division and the Andersen Accounting Division were entangled in persistent animosity over the pay scale inequalities. In an attempt to restore some order, Harvey Kapnick tried to split the warring factions into separate entities, but to no avail. Andersen partners vehemently rejected that proposal. As you might have guessed, the rancor persisted. A far lethal problem was the firm's unethical and dubious auditing practices. Employees had an increasing tendency to accede to their clients' wishes in order to drive up revenues. They were consumed by evil greed and poor decision-making in an intensely competitive environment. Unfortunately, Andersen had become ungovernable due to its immense growth. Other problems took the shape of creditors and shareholders of bankrupt companies. They fiercely claimed that the Andersen firm neglected to realize the extent of the bankrupt company's financial woes. And also that Andersen failed to publicize those findings. Therefore, the firm got embroiled in several Mortal Kombat lawsuits. The court ordered Andersen to cough up over $57 million within 2 months, in 1984.
The world's greatest consulting firm.
In 1988, Andersen's consulting services accounted for 40% of total revenue, making it the world's leading consulting firm. As you may know, it became an important milestone in the firm's growth trajectory. The business community respected this accounting and auditing behemoth. To quell the chaos that was flaring up between the Arthur Andersen and Company and Andersen Consulting, executives tore them into 2 companies. The Switzerland-based Andersen Worldwide SC was governing the 2 chaotic entities.
Enron's awful secret.
Andersen's biggest and high-fee-paying cash cow client did a despicable thing over the years. Enron Corporation had been secretly hiding losses from its shareholders through intricate partnerships. It was slyly reducing its costs and growing its earnings. Andersen discovered this nasty puzzle in 1998. What's even more perplexing is that Andersen Company foolishly clung to Enron and kept the bottom line issue hush-hush. As a result, Andersen continued milking Enron of over $52 million in audit and consulting fees each year. It surpassed $14 billion in revenues. This accounting consulting giant quickly gained momentum, boasting of 382 offices in over 80 countries across the globe. It was a stalwart in the accounting, consulting and auditing community.
The Andersen traumatic rancor comes to an end.
The incessant and most vicious 3-year family feud between the accountants and the consultants was halted by the International Court of Arbitration in Paris. At the heart of their animosity is the issue of money. Consultants were reluctant to share their profits with the firm's accountants, whose division had reached the stagnation levels. Perhaps, what fueled the flames of the rancor was that the accountants had opened their consulting division as well. In 2000, the international arbitrator ruled that the 2 squabbling factions be split to different operating divisions and freed from the parent company. It was a victory for Andersen Consulting. On top of that, the international arbitrator ordered Andersen Consulting to adopt a fresh new corporate title. Subsequently, Andersen Consulting changed its name to Accenture Limited. Soon after that, they began aggressively marketing their new brand name.
Andersen and the Enron Scandal.
In 2001, Andersen Worldwide showed an impressive growth of 1.2% in its total revenues. The number of international offices skyrocketed to over 390 offices. This corporate titan was now raking in more than $1.1 billion of consulting profits. However, their cash cow client and energy giant dropped a bomb. Enron disclosed that the Securities and Exchange Commission was launching an inquiry into Enron and Andersen's actions. David Duncan and his Andersen subordinates started shredding some of Enron's sensitive financial documents. On top of that, they also tried to conceal email documents. What was their game plan? You might wonder. It eventually surfaced that they performed these questionable practices in a desperate attempt to cover their tracks and elude the prying eyes of the Securities and Exchange Commission investigations. In December, Joseph Berardino, the CEO of the comprised accounting firm, exposed himself to intense scrutiny. He appeared before the U.S. Congress, defending Andersen's accounting and auditing improprieties. It became obvious that securing a job at Andersen was like fighting for a seat at the Titanic ship.
Collapse of Andersen's business.
As early as 2001, all corporate divisions experienced the fast-growing client exodus by dozens to Andersen's competitors. Many employees jumped ship and sought employment with Andersen's rivals. The embattled accounting and auditing firm received the final blow in March 2002. Arthur Andersen was indicted on a humiliating obstruction of justice charge relating to the collapse of Enron Corp. The indictment alleged that this Titanic had shredded and destroyed tons of crucial Enron documents. As grave as the matter was, the jury found that the company was guilty of obstructing justice through the shredding of evidence. As the night follows the day, the jury forbade Andersen worldwide from practicing and revoked its license. Andersen's appeal to the federal appellate court counted as the last kick of a dying horse. The court confirmed the jury's previous verdict. One thing remained for this fallen accounting behemoth. That was the tedious and arduous task of closing down forever.
Conclusion.
Arthur Andersen was a distinguished and immensely successful global company. The firm escaped unscathed, a series of accounting scandals, and maintained their special place as the captain of the industry. The Enron Scandal derailed the Arthur Andersen firm. It was one of the most spectacular meltdowns of the once prominent, self-proclaimed watchdog of the auditing and accounting community. The accounting community received a wake-up call to revisit accounting methods and procedures and revise the ethical behavior of the professionals.
This video is brought to you by Preciseby.com, a simplified accounting software and an online invoicing platform. Click on the link below to find out more about Preciseby.com.